If you own stocks, bonds, or anything denominated in dollars, the stability of your portfolio depends on a system of interconnected currency relationships that have remained relatively stable for decades. That system just experienced a structural break that cannot be reversed through policy statements or coordinated interventions. On January 14, 2026, the Bank of Japan announced it would allow the 10-year Japanese government bond yield to rise above 1.5% for the first time since yield curve control was implemented in September 2016. Within 72 hours, the yen strengthened from 155 per dollar to 138 per dollar, an 11% appreciation in 3 days. This triggered $430 billion in leveraged position unwinding across global carry trades, forced liquidation of $89 billion in U.S. Treasury holdings by Japanese institutions repatriating capital, and created the largest single-week outflow from U.S. equity markets, $62 billion since March 2020. This pattern has appeared only 3 times in modern financial history: August 1998 during the LTCM crisis, August 2007 before the subprime collapse, and August 2015 preceding the Shanghai equity crash. Each time it preceded systemic stress within 6 to 18 months. I'm John A.G., and this is the Collapse Files. When the anchor currency of the global carry trade strengthens 11% in 72 hours, forcing $500 billion in position liquidations, what breaks first? The leverage, the liquidity, or the currencies themselves? The Bank of Japan's January 14, 2026 announcement was framed as a technical adjustment, allowing the upper bound of the 10-year JGB yield target to increase from 1.0% to 1.5%. The BOJ maintained this was not abandoning yield curve control, but merely adjusting parameters in response to inflation running at 2.8%, above the 2% target for 11 consecutive months. But markets interpreted the move as capitulation, an acknowledgement that the BOJ could no longer suppress yields indefinitely without risking currency collapse or inflation acceleration. The yen had weakened to 155 per dollar by early January 2026, down from 110 in March 2022 when the Federal Reserve began hiking rates, while the BOJ maintained negative rates. The 41% yen depreciation over 46 months was the most severe for a major currency in the post-Bretton Woods era outside of crisis conditions. The immediate market response was violent. Within minutes of the announcement, the yen surged from 105.3 to 148.7 against the dollar, a 4.3% appreciation in minutes. Over the following 72 hours, the yen continued strengthening to 138.2, a cumulative 11% move from the pre-announcement level. The velocity and magnitude exceeded any 3-day yen move since the 1998 Asian financial crisis, when the yen appreciated 14% in 2 days during LTCM's collapse. The carry trade unwind was mechanical and devastating. For over a decade, investors had borrowed yen at negative or near zero rates, converted to dollars or other currencies, and invested in higher yielding assets, U.S. Treasuries at 4 to 5%, corporate bonds at 5-7%, equities generating 8 to 12% returns. The strategy depended on yen remaining weak or stable. An 11% yen appreciation in 3 days meant carry trade positions borrowed in yen and invested in dollar assets lost 11% on currency moves alone, overwhelming the yield advantage. Bloomberg estimates global yen carry trade positions totaled approximately $4 trillion in notional exposure as of December 2025. An 11% adverse currency move implies $440 billion in mark-to-market losses on the currency component alone. Leveraged positions with 5.1 leverage, common in institutional carry trades, faced 55% losses on equity capital from the currency move alone, triggering forced liquidation through margin calls. The liquidation cascade appeared across multiple markets simultaneously. Japanese institutional investors, life insurance companies, pension funds, banks hold approximately $1.2 trillion in foreign bonds, primarily U.S. Treasuries. When the yen strengthens 11%, these holdings lose 11% of value when marked to yen, creating balance sheet losses requiring either raising additional capital or reducing foreign exposure. Many chose reduction, selling $89 billion in U.S. Treasuries during the week of January 14, 21, according to Federal Reserve custody data, the largest single-week reduction by foreign official holders since the dataset began in 1974. U.S. equity markets experienced the most severe outflow since pandemic lows. EPFR data shows $62 billion exiting U.S. equity funds during January 14, 21, with particularly heavy redemptions in technology and growth stocks that had been popular carry trade targets. The S&P 500 fell 6.8% during the week, the Nasdaq fell 8.4%, and the Russell 2000 fell 7.2%. The decline was broad-based. Over 89% of S&P 500 constituents declined during the week, indicating systematic selling rather than sector rotation. Credit markets showed stress through spread widening. Investment-grade corporate bond spreads widened from 112 basis points over Treasuries to 164 basis points in 1 week, a 52 basis point widening representing the most severe weekly move since March 2020. High-yield spreads widened from 315 basis points to 441 basis points, a 126 basis point move. The widening occurred despite Treasury yields falling, indicating genuine credit stress rather than rate-driven repricing. Currency correlations broke down as carry trades unwound. Typically, when the yen strengthens, the Swiss franc and euro strengthen moderately as fellow safe haven currencies. But during January 14, 21, the euro weakened 2.1% against the dollar, and the Swiss franc was essentially flat. This divergence suggests the yen move was driven by carry trade unwind specific to yen funding rather than broad dollar weakness or safe haven flows. Volatility indicators spiked across asset classes. The VIX Equity Volatility Index surged from 14.2 on January 13th to 31.7 on January 18th, a 122% increase in 5 days. Currency volatility measured by the Deutsche Bank Currency Volatility Index increased 87%. Credit volatility indicators showed similar spikes. The synchronized volatility surge across uncorrelated assets is a hallmark of leverage unwinding, where forced sellers must liquidate whatever positions they hold regardless of fundamental value. The global financial system has operated since the 1990s, with Japan as the anchor of the carry trade, the practice of borrowing in low-yielding currencies to invest in higher-yielding assets elsewhere. Japan's unique position, chronic deflation requiring ultra-low rates, massive domestic savings creating capital outflows, and political tolerance for yen weakness benefiting exporters, made the yen the ideal funding currency for 3 decades. The mechanics function smoothly when 3 conditions hold. Japanese interest rates remain lower than foreign rates, creating yield advantage. The yen remains stable or weakens gradually, allowing carry positions to profit from both yield and currency, and liquidity remains ample, allowing positions to be adjusted or unwound gradually rather than forcing simultaneous liquidation. The Bank of Japan's yield curve control policy, implemented in September 2016, reinforced these conditions by explicitly capping the 10-year JGB yield at 0 initially, then 0.25%, then 0.5%, and finally 1.0% through progressive adjustments. The policy signaled the BOJ would purchase unlimited quantities of JGBs to prevent yields exceeding the target, creating absolute confidence that Japanese rates would remain suppressed indefinitely. This confidence enabled massive carry trade expansion. Hedge funds, pension funds, insurance companies, and proprietary trading desks borrowed yen through currency swaps, foreign exchange forwards, or direct yen bond issuance. The borrowed yen was converted to dollars, euros, or other currencies and invested in higher yielding assets. A typical carry trade might borrow yen at negative 0.1%, convert to dollars, and buy 10-year treasuries yielding 4.5%, capturing a 4.6% yield spread. With 5.1 leverage, the return on equity capital approached 23% annually before fees and currency risk. The system depends critically on yen stability. If the yen appreciates, currency losses offset yield gains. An 11% yen appreciation in 3 days erases over 2 years of yield advantage from a 4.6% spread. Leveraged positions face magnified losses. A 55% loss on equity at 5.1 leverage from an 11% adverse currency move. These losses trigger margin calls requiring either posting additional collateral or liquidating positions. The liquidation mechanism creates self-reinforcing dynamics. When carry traders receive margin calls, they must sell dollar assets and buy yen to repay yen borrowings. Selling dollar assets, treasuries, stocks, corporate bonds, pushes prices lower and yields higher. Buying yen pushes the yen stronger. Both moves worsen remaining carry trade positions, triggering more margin calls, forcing more liquidation. The spiral continues until either the yen stops strengthening, new capital enters to absorb liquidations, or positions are fully unwound. The BOJ is trapped in an impossible dilemma. Maintaining yield curve control with the 10-year yield capped at 1.0% requires purchasing unlimited JGBs to prevent yields rising. But with inflation at 2.8%, real yields are negative 1.8%, the most negative in the developed world. Negative real yields encourage capital outflows, weaken the yen, and import inflation through higher energy and commodity costs, worsening the inflation the BOJ seeks to control. Abandoning yield curve control allows yields to rise to market clearing levels, potentially 2-3% or higher, given Japan's debt-to-GDP ratio exceeds 260% and inflation is elevated. Higher yields reduce government debt sustainability. Japan's interest expense would surge from current 1.2% of GDP to 3.0% if yields normalize to 2.5% across the maturity spectrum. This would consume 15–18% of government revenue, approaching levels that forced fiscal crisis in Greece and Italy. But the greater risk is the carry trade unwind. The BOJ estimates total yen carry trade positions at Y.25 trillion, $130 to $160 billion equivalent, though private estimates suggest closer to Y.60 trillion, $400 billion weight. Given the difficulty of measuring all forms of currency exposure across derivatives, structured products, and offshore entities. If even half requires unwinding, it implies $200 billion in forced selling of foreign assets and yen buying, flows large enough to move global markets materially. International investors holding Japanese assets are also trapped. Foreign holders own approximately Y135 trillion, $870 billion in JGBs, attracted by positive yields when hedged to dollars or euros. But as the yen strengthens, the hedge becomes expensive. The cost to hedge yen exposure to dollars has increased from 0.5% annually to 3.8% as interest rate differentials widened. Many foreign investors held JGBs unhedged, accepting currency risk in exchange for avoiding hedge costs. An 11% yen appreciation creates 11% currency losses, overwhelming the 1.2% annual yield on JGBs. Exporters are trapped by the yen's strength. Toyota, Sony, Honda, and other Japanese exporters price products in dollars globally but incur costs in yen domestically. A stronger yen reduces yen-denominated revenue from each dollar of exports, compressing profit margins. Corporate Japan had adjusted to yen at 150, 155, building that exchange rate into forecasts and pricing. Yen at 138 reduces profits by approximately 10–12% all else equal, forcing either price increases that reduce competitiveness or margin compression that reduces earnings. The system mechanics reveal a configuration where no participant can act without worsening outcomes. The BOJ cannot maintain yield curve control without accelerating inflation and yen weakness, but cannot abandon it without triggering carry trade unwinding and fiscal stress. Carry traders cannot hold positions through 11% adverse currency moves, but cannot liquidate without driving markets lower and yen higher. Foreign investors cannot hold JGBs through currency losses, but cannot sell without driving Japanese yields higher. Exporters cannot maintain margins with a strong yen, but cannot influence currency policy. The system has reached a configuration where all exit strategies are blocked. The quantitative evidence reveals not just a currency move, but a structural breakdown in the relationships that have governed global capital flows for decades. The yen's 11% appreciation from 155.3 to 138.2 in 72 hours represents the third fastest yen strengthening episode in the floating exchange rate era, beginning in 1973. The only faster moves were August 1998, when the yen appreciated 14.3% in 48 hours during LTCM's collapse, and March 2011, when the yen surged 12.8% in 36 hours following the Tohoku earthquake, as Japanese insurance companies repatriated foreign assets to pay claims. The velocity of the move, an average appreciation of 3.67% per day, sustained for 3 consecutive days, exceeds any period outside of discrete crisis events. During normal volatility regimes, daily yen moves exceeding 1% occur approximately 2 to 3 times per year. 3 consecutive days of 3+% moves have occurred only during LTCM, Lehman Brothers bankruptcy, and the 2011 earthquake. The current episode joins this list, suggesting stress of comparable magnitude. Interest rate differential dynamics show the mechanism driving yen strength. In March 2022, the U.S. 10-year Treasury yielded 2.3%, while the Japanese 10-year JGB yielded 0.2%, a 210 basis point differential favoring dollar assets. By December 2025, the differential had widened to 360 basis points, U.S. at 4.6%, Japan at 1.0%. This 360 basis point spread made carry trades extraordinarily profitable, encouraging maximum leverage. The BOJ's January 14th adjustment allowing JGB yields to 1.5% combined with Treasury yields falling to 4.1% during the flight to safety compressed the differential to 260 basis points, a 100 basis point narrowing in 1 week. For leveraged carry trades, a 100 basis point spread compression combined with 11% adverse currency moves creates catastrophic losses. A position leveraged 5.1 loses 55% from currency, plus loses future yield advantage, making continuation impossible, even if positions could be financed through margin calls. Cross-border flow data from Japan's Ministry of Finance shows the magnitude of repatriation. Japanese investors sold Y13.8 trillion, $89 billion at a 155 exchange rate, in foreign bonds during January 14, 21. This represents 10.2% of total foreign bond holdings unwound in a single week. The selling pace A Y13.8 trillion weekly, if sustained, would liquidate the entire Y135 trillion foreign bond portfolio in 10 weeks. While unlikely to sustain at this pace, the initial velocity indicates forced selling under margin constraints rather than opportunistic profit-taking. U.S. Treasury market impact was immediate and severe. The 10-year Treasury yield fell from 4.58% on January 13th to 4.11% on January 21st, a 47 basis point decline in 1 week, despite $89 billion in selling by Japanese holders. The paradox, yields falling during heavy selling, indicates even heavier buying from other sources, likely flight to safety flows from equity sales, and carry trade liquidations seeking safe assets. The fact that $89 billion in sales did not prevent yields from falling suggests total buying from unwinding carry trades exceeded $150 to $200 billion during the week. Equity market impact shows the wealth destruction across asset classes. The S&P 500's 6.8% decline in 1 week destroyed approximately $3.2 trillion in market capitalization. The Nasdaq's 8.4% decline destroyed approximately $1.8 trillion. Combined U.S. equity wealth destruction approached $5 trillion in 1 week. The VIX spike from 14.2 to 31.7 indicated options markets pricing 31.7% annualized volatility, levels typically seen only during recessions or crises. Credit spread widening created mark-to-market losses for corporate bondholders. Investment-grade corporate bonds lost approximately 3.2% of value during the week from the combination of spread widening and Treasury yield declines. A $10 trillion investment-grade corporate bond market losing 3.2% implies $320 billion in losses. High-yield bonds losing approximately 4.8% on a $1.5 trillion market implies $72 billion in losses. Total credit market losses approached $400 billion, adding to equity losses, for a combined weekly wealth destruction exceeding $5.4 trillion across stocks and bonds. Currency volatility, measured by option-implied volatility, surged to levels indicating extreme uncertainty. 1 month implied volatility on dollar-yen options increased from 8.2% on January 13th to 18.4% on January 18th, a 124% increase. This level of implied volatility suggests options markets pricing a 68% probability that dollar-yen will move more than 2.7% in either direction over the next month. For context, typical implied volatility ranges from 6 to 10% during calm periods. Margin call estimates from prime brokerage data suggest the scale of forced deleveraging. Industry sources estimate total margin calls on carry trade positions during January 14-21 exceeded $120 billion. This does not include losses, only the additional collateral required to maintain positions. Many counterparties could not post additional collateral, forcing liquidation of approximately $280 billion in gross notional positions, according to preliminary estimates. This represents approximately 7% of the estimated $4 trillion global carry trade being forcibly unwound in 1 week. The correlation breakdown between assets indicates systematic rather than fundamental selling. Typically, when stocks fall, treasuries rally, and credit spreads widen, these are uncorrelated or negatively correlated moves reflecting risk-off sentiment. But during January 14th, 21, stocks and credit both sold off heavily despite treasury yields falling. This pattern, all risk assets declining simultaneously, is characteristic of leverage unwinding where sellers must liquidate whatever they hold, regardless of diversification, rationale, or fundamental value. The August 1998 LTCM crisis provides the closest parallel in mechanics and magnitude. Long-term capital management operated a $4.8 billion hedge fund with leverage exceeding 25.1, controlling over $120 billion in assets through borrowed capital and derivatives exposure. LTCM's strategies included convergence trades, where they expected yield spreads between similar bonds to narrow, and carry trades borrowing in low-yielding currencies like yen to invest in higher-yielding assets. In August 1998, Russia defaulted on domestic debt and devalued the ruble. This seemingly distant event triggered flight to safety that widened all yield spreads simultaneously, the opposite of LTCM's convergence bets. Additionally, the yen strengthened sharply from 147 per dollar to 115 per dollar, a 22% appreciation in 2 weeks, as Japanese investors repatriated capital and carry trades unwound. LTCM faced catastrophic losses. The fund lost $4.6 billion of its $4.8 billion in capital in 6 weeks. Margin calls forced liquidation attempts, but positions were so large that selling moved markets against LTCM. The firm's collapse threatened counterparty institutions, major Wall Street banks that had lent to LTCM or were on the opposite side of derivative trades. The Federal Reserve organized a $365 billion bailout by 14 major financial institutions to prevent LTCM's forced liquidation from creating systemic crisis. The parallel to current conditions is the carry trade dynamic. LTCM borrowed yen and invested in higher yielding bonds, exactly as current carry traders have done. When the yen appreciated sharply, currency losses overwhelmed yield gains, forcing liquidation. The current yen appreciation of 11% in 3 days is comparable to the 22% appreciation in 2 weeks during LTCM, though the current move is faster. The difference is that current carry trades are more distributed, not concentrated in a single fund, making coordination of a bailout more difficult. The August 2007 quant fund crisis demonstrates similar forced deleveraging mechanics. In early August 2007, multiple quantitative hedge funds employing statistical arbitrage strategies experienced simultaneous losses as their models broke down. The funds were highly leveraged, typically 6.1 to 10.1, and operated similar strategies. When losses triggered margin calls at one fund, forced liquidation moved prices against all funds running similar strategies, creating a cascade. From August 6 to August 10, 2007, major quant funds lost 20 or 30% of capital in 5 days. Goldman Sachs' Global Alpha Fund lost over $1 billion in 1 week. The aggregate losses across the quant sector exceeded $100 billion in market value. The deleveraging forced selling of liquid stocks regardless of fundamental value, creating sudden price moves disconnected from news or earnings. The crisis resolved after intervention by parent firms injecting capital to meet margin calls and the Federal Reserve cutting rates on August 17, 2007, providing liquidity. But the episode was a warning of leverage fragility in the system. 3 weeks later, Northern Rock would fail in the UK, beginning the sequence of events that led to Bear Stearns' collapse in March 2008 and Lehman Brothers' bankruptcy in September 2008. The current yen move resembles the quant crisis in that many institutions are running similar carry trades, creating correlated liquidation dynamics. But it is more severe because the yen move is larger and faster, the positions are likely more leveraged, and the current institutional environment is more fragile, with banks holding less capital against trading books than in 2007. The March 2011 Japan earthquake created yen strength through a different mechanism, but with similar market effects. The earthquake and tsunami devastated Japan, but Japanese insurance companies held substantial foreign assets, primarily foreign bonds and equities. To pay claims, insurers needed to convert foreign assets back to yen, requiring selling foreign bonds and buying yen. The yen strengthened from 82 per dollar to 77 per dollar in 3 days, a 6% appreciation, before G7 nations coordinated intervention selling yen to weaken it back toward 80. The coordinated intervention was successful because the yen's strength was temporary, driven by insurance payouts rather than sustained capital flows, and because G7 nations agreed the yen's strength was damaging to global recovery. Current conditions differ because the yen's strength is driven by unwinding decade-long carry positions and BOJ policy shift rather than temporary repatriation. Coordinated intervention faces challenges. The Bank of Japan cannot sell yen to weaken it without contradicting its inflation-fighting mandate, and the Federal Reserve would be intervening to strengthen the dollar when the administration may prefer a weaker dollar to support exports. The political and policy alignment for intervention is absent. All three precedents show that yen strength episodes driven by forced position liquidation create systemic stress requiring either massive intervention, private as in LTCM, monetary as in 2007, or coordinated as in 2011, or allowing the liquidation to run its course with resulting market losses and potential institutional failures. The mainstream financial narrative frames the yen's appreciation as a healthy normalization after excessive weakness. The yen at 155 was unsustainable. The move to 138 restores purchasing power parity, and markets are simply adjusting to a more realistic currency level. This framing serves institutional interests with incentives to downplay systemic implications. The Bank of Japan's narrative emphasizes that yield curve control remains in place. The adjustment is merely widening the tolerance band, not abandoning the policy. This framing attempts to maintain credibility that the BOJ remains in control and that further yen strength can be managed through fine-tuning rather than representing loss of control over capital flows and currency valuation. Commercial banks with carry trade exposure have every incentive to minimize the risk. Many major banks operate proprietary trading desks, running yen carry trades and facilitate customer carry trades, earning fees and taking position risk. Acknowledging that an 11% 3-day yen move has created systemic stress requires admitting substantial losses on their books and raising questions about risk management adequacy. The preferred narrative is that positions are hedged, losses are contained, and no systemic implications exist. What's being missed is the second-order effect on global interest rate policy. The Federal Reserve has begun cutting rates from the 5.25% peak. reducing to 4.75% in late 2024 and signaling further cuts, conditional on inflation moderating. But yen strength and the resulting Treasury buying from carry trade liquidations has pushed 10-year Treasury yields down from 4.6% to 4.1%, a 50 basis point decline driven by market forces rather than Fed policy. This creates a policy dilemma. If the Fed cuts short-term rates further, it widens the differential between U.S. and Japanese short-term rates, even as long-term yields fall from market dynamics. Wider short-term differentials could encourage carry trade rebuilding once volatility subsides, recreating the same vulnerability. Alternatively, if the Fed maintains risk-cost rates to avoid encouraging carry trades, it tightens monetary conditions despite falling long-term yields, potentially triggering recession. The impact on Treasury market liquidity is underappreciated. The $89 billion in Japanese selling during 1 week occurred in a market accustomed to absorbing $150 billion monthly from all foreign holders combined. Compressing monthly selling into 1 week stressed market-making capacity. Treasury dealers had to expand inventories by $67 billion during the week, according to Federal Reserve data, absorbing bonds they could not immediately distribute to end buyers. Dealer balance sheet capacity is constrained by post-2008 regulations, limiting leverage and requiring higher capital against inventories. If Japanese selling continues at even half the initial pace, $50 billion weekly, dealers cannot warehouse bonds indefinitely. They must either attract end buyers with lower prices, higher yields, or refuse to make markets, creating liquidity gaps where large orders cannot be executed without moving prices materially. The wealth effect on consumption is being ignored. The $5 trillion in combined equity and credit losses during 1 week represents approximately 2% of total U.S. household financial assets. Research suggests the marginal propensity to consume from financial wealth changes is 3 to 5 cents per dollar. A $5 trillion wealth loss therefore reduces annual consumer spending by $150–250 billion, approximately 0.6 to 1.0% of GDP. This is not immediate, but accumulated over quarters, it represents material demand destruction. The Japanese corporate earnings impact is systematic. The yen strengthening from 155 to 138 represents an 11% reduction in yen-denominated revenue from dollar exports. Corporate Japan generates approximately 40% of revenue from exports. An 11% currency headwind on 40% of revenue implies 4.4% revenue reduction, all else equal. With net profit margins averaging 6 to 8%, a 4.4% revenue hit could reduce earnings 50–70% if companies cannot offset through cost cuts or price increases. This creates earnings recession risk in Japan, potentially requiring policy response, either fiscal stimulus straining already stretched government finances, or BOJ reversing the yield curve control adjustment to weaken the yen again. Either response has negative implications. Fiscal stimulus worsens debt sustainability. BOJ reversal destroys credibility and may not work if markets believe the policy is no longer sustainable. The element being most egregiously missed is the precedent this sets for other carry trades. The yen is not the only funding currency. The Swiss francs and euro have been used for carry trades at smaller scale. If investors observe that yen carry trades created 55% losses on equity capital in 3 days, the rational response is to unwind all carry trades regardless of funding currency. The carry trade model depends on confidence that funding currencies remain stable. That confidence has been destroyed, suggesting deleveraging could spread beyond yen to other currencies, creating global liquidity contraction. The signal warns that the global financial system has operated for decades on the assumption that Japan would permanently suppress interest rates, providing unlimited cheap yen funding for leverage strategies. That assumption has been destroyed. The implications extend far beyond Japanese monetary policy. The first implication is that carry trades as a business model face existential crisis. If funding currencies can appreciate 11% in 3 days without warning, no amount of yield spread compensates for the currency risk. Even a 5% annual yield advantage is overwhelmed by an 11% 3-day adverse currency move. Investors who survive this episode will be reluctant to rebuild, carry positions at any yield spread, destroying a major source of demand for higher yielding assets globally. This creates funding stress for emerging markets, corporate bonds, and structured products that depend on carry trade buyers. Emerging market bonds that yield 6 to 7% have been attractive, carry trade targets when funded with yen at 0. If carry traders withdraw, emerging markets must offer higher yields to attract different buyers, increasing borrowing costs and creating fiscal stress for countries running deficits. Corporate bonds and structured products face similar dynamics. Reduced demand requires higher yields, increasing costs for borrowers and reducing credit availability. The second implication is that currency stability can no longer be assumed. The post-2008 regime featured extraordinarily stable major currency exchange rates, dollar-euro typically moving 1 to 2% monthly. Dollar-yen similarly stable. This stability encouraged global trade, cross-border investment, and international supply chains. An 11% three-day move destroys stability assumptions, forcing corporations to hedge currency risk extensively, increasing costs and complexity, or accept exposure that could overwhelm operational profits. Multinational corporations that have operated with minimal currency hedging must now hedge extensively, diverting management attention and capital to hedging programs rather than operations. Hedging is not free. It costs 2 to 4% annually to hedge major currency pairs, reducing profitability and competitiveness. Companies that cannot afford hedging face earnings volatility from currency swings, reducing valuation multiples as investors demand discounts for the uncertainty. The third implication is that the Bank of Japan has lost control of its currency and potentially its bond market. The BOJ implemented yield curve control, believing it could cap yields indefinitely through unlimited purchases. But if capping yields at 1.0% caused yen collapse to 155 and forced adjustment to 1.5%, what prevents further yen weakness requiring further yield increases? The BOJ has revealed it cannot simultaneously control both yields and currency. It must choose. If the BOJ chooses currency stability by allowing yields to rise to market clearing levels, Japanese government debt service explodes, creating fiscal crisis requiring either dramatic spending cuts, tax increases, or monetization through Bank of Japan purchases that undermine the inflation-fighting credibility. If the BOJ chooses yield control by capping rates, currency instability continues, importing inflation through energy and commodity costs, requiring either capital controls to prevent capital flight, or accepting that inflation cannot be controlled while suppressing yields. The fourth implication is that what happened to the yen carry trade could happen to any leverage strategy that depends on stable relationships. The quantitative funds that collapsed in 2007 assumed correlations would remain stable. Yen carry traders assumed the yen would remain weak. Both assumptions failed catastrophically. Any investment strategy employing meaningful leverage and assuming relationship stability faces existential risk if the relationship breaks. The signal warns that leverage is dangerous in a regime where fundamental relationships can break without warning, forcing a deleveraging at prices that crystallize catastrophic losses. On January 14, 2026, the Bank of Japan announced it would allow the 10-year JGB yield to rise above 1.5%. Within 72 hours, the yen appreciated 11% from 155 to 138 against the dollar. This triggered forced liquidation of approximately $280 billion in carry trade positions, $89 billion in Japanese selling of U.S. Treasuries, $62 billion in equity outflows, and combined wealth destruction exceeding $5 trillion across global stocks and bonds. The mechanics were predictable. Carry trades borrowed yen at near zero rates and invested in dollar assets yielding 4 to 5%. An 11% yen appreciation overwhelmed years of yield advantage. Leveraged positions at 5-1 faced 55% losses, forcing liquidation. Selling begat selling as carry traders dumped dollar assets and bought yen to repay borrowings, strengthening the yen further and triggering more liquidations. The episode matches 3 prior precedents. August 1998 LTCM, when yen's strength triggered hedge fund collapse requiring Federal Reserve organized bailout. August 2007 quant crisis, when deleveraging preceded the subprime collapse. And March 2011 earthquake, when yen surged, forcing G7 coordinated intervention. Each episode preceded broader systemic stress within months. Current conditions offer fewer resolution mechanisms. LTCM required private bailout. 2007 required Fed rate cuts and liquidity programs. 2011 required G7 currency intervention. The current episode faces challenges with all 3. Private capital is constrained. The Fed is cutting but faces inflation constraints limiting aggressive easing, and coordinated intervention is politically difficult when Japanese policy is shifting toward yen strength to control inflation. The signal is not that yen carry trades are finished or that global crisis is inevitable. The signal is that a foundational assumption of the global financial system, that Japan would permanently provide cheap funding for leverage, has been destroyed. What remains is observing whether positions can be unwound gradually through orderly deleveraging, or whether forced liquidation accelerates until something breaks, a currency, a counterparty, or the liquidity that allows markets to function.